How interest rates affect the stock and bond markets. When we're talking about interest rates, they definitely affect all markets. But today we're going to dive into stocks and bonds. So first, let's start with stocks. When interest rates rise, it also makes it more expensive for companies to raise capital. They will have to pay higher interest rates on the bonds that they issue. For example, making it more costly to raise capital could put a damper on future growth prospects as well as near-term earnings. The result could be a revision downward in profit expectations going forward as rates increase. If a company is seen as cutting back on its growth or it's less profitable, either though higher debt expenses or less revenue, the estimated amount of future cash flows will drop. All else being equal, this will lower the price of the company's stock. If enough companies experience declines in their stock prices, the whole market or the key indexes many people equate with the market, like the Dow Jones Industrial Average, the S&P 500, etc., any of the indexes will go down. With a lowered expectation in growth and future cash flows of a company, investors will not get as much growth from stock price appreciation. This can make stock ownership less desirable. Furthermore, investing in equities can be viewed as too risky when compared to other investments. However, some sectors stand to benefit from interest rate hikes. One sector that tends to benefit the most is the financial industry, being banks, brokerages, mortgage company, and insurance companies. Earnings often increase as interest rates move higher because they can charge more for lending. However, that does come at an eventual price or cost. As borrowing costs get more expensive and customers stop going to banks, brokerages, and mortgage companies for mortgages, for things like that, they also start to see a hurting in their earnings because they have less customers. So now let's talk about bonds. Interest rates also affect bond prices. There is an inverse relationship between bond prices and interest rates, meaning that as interest rates rise, bond prices fall. And as interest rates fall, bond prices rise. I know it's confusing. It took me a long time to get my head wrapped around that one. The reason for this is actually quite straightforward. Say a bond with a $1,000 face value pays 5% interest annually. Okay, that's $50 per year in interest. At a fixed interest rate, it is issued when prevailing interest rates are also 5%. Say later that year, interest rates rise to 10%. They double. A bond investor could now buy a new bond for $1,000 and be paid $100 per year for holding it. This means that the old bond, which pays only $50 per year, has to be worth less. So the only way someone would buy the 5% bond would be at a discount in the market. Now, say interest rates instead fall to 1%. A new bond purchased for $1,000 would only pay $10 per year to bondholders. The old one that pays $50 is now very attractive, and the market would bid this up, so it trades at a premium in the market. One way that governments and businesses raise money is through the sale of bonds. As interest rates move up, the cost of borrowing becomes more expensive. This means that demand for lower yield bonds will drop, causing their price to drop. As interest rates fall, it becomes easier to borrow money, and many companies will issue new bonds to finance expansion. This will cause the demand for higher yielding bonds to increase, forcing bond prices higher. Issuers of callable bonds may choose to refinance by calling their existing bonds so they can lock in a lower interest rate. For income-oriented investors, reduction in the federal funds rate means a decreased opportunity to make money from interest. Newly issued treasuries and annuities won't pay as much. A decrease in interest rates will prompt investors to move money from the bond market to the equity market. The influx of new capital instead can cause the equity markets to rise. I hope this brings to light some of the influences that interest rates have on both the US stock market and bond market. It's really important to realize that as rates start to rise, or as rates start to fall, that the effects will not be seen right away. Rather, they will be seen into the future, 3 months, 6 months, 9 months, and even sometimes multiple years later, when it depends on how sharp they rise or how fall they fast. That's really what it all comes down to. So when the Federal Reserve starts making their move, either to the upside or downside, start paying attention and plan accordingly because the future will be dictated by what the Fed does today.